Hey, what's up, you guys? Swan here from Swan Things, and today I'll be giving you a complete breakdown of REITs or real estate investment trusts. So, in this video, I'll be covering everything you need to know about REITs, including how it works, the pros and cons, and also my recommendation for the best Malaysian REITs. So, without further ado, let's begin. So, for those who aren't familiar, a REIT is a stock that is traded openly on the stock exchange, and it allows normal people with not a lot of money to easily invest in real estate. A REIT pools money from investors to purchase and rent out properties. These properties are managed by REIT managers who can acquire, grow, and divest assets within the REIT. These managers may outsource the daily operations to property managers, who attracts and retains tenants and maintains these properties. The properties of a REIT are held by trustees, who ensure that these assets are managed in a way that benefits shareholders. These three parties will each charge a fee for their services, and when rental income is generated, the profits are distributed to investors as dividends. This makes REITs an attractive investment because even someone with a small capital can invest in real estate by simply purchasing a REIT stock. Once you're an owner of a REIT, you are effectively a small owner of a wide variety of properties. You're entitled to a portion of profits from rental income as well as any capital gains if the stock price goes up. The second advantage is liquidity. Because REITs are traded as a stock, you can easily liquidate or sell off your stocks and get your money back within a day or two. This is unlike buying rental properties, which is illiquid because the process of selling off a property is difficult and time consuming. Another great thing about REITs is that the properties are managed by professionals, and so there's no need for you to worry about bad tenants, late rental payments, or maintenance issues. The income generated from REITs are truly passive. The fourth advantage is in diversification. Oftentimes, a REIT will own a variety of properties of different types, location, and industries. For example, IGB REIT owns retail properties. YTL REIT focuses on hospitality, while Sunway REIT owns everything from malls, offices, hotels, and even a hospital. So instead of concentrating all your risk into a single rental property, you can easily diversify your risk into multiple properties by simply purchasing one REIT stock. Next, REITs are known for generating consistent, recurring, high yield dividends. And this is possible because of a few tax advantages. First, a REIT is not required to pay stamp duty on a property's purchasing price. Next, they are also exempted from paying real properties gains tax when they choose to sell off their properties. Third, REITs are also given a special corporate tax exemption if they choose to give out 90% of their income as dividends to shareholders. All of these advantages allow REITs to generate higher income to pay out higher dividends. The profits of a REIT are not taxed at a corporate level but at an individual level. So this means that a 10% withholding tax is imposed on the dividends paid out to shareholders. This tax is automatically deducted when you receive your dividends. These dividend payouts are also fairly regular, making REITs a really good option for those who are looking for positive cash flow investments. Last but not least, REITs carry a relatively low risk profile compared to normal stocks. This is partly because REITs are legally bound to rules and regulations that protect the interests of small shareholders. These rules are set in place to ensure capital preservation and a consistent return on investment. For example, REITs must hold at least 75% of their net assets in real estate, and 75% of their income must be derived from rental income. Properties acquired must be held for a certain period of time, and there is also a focus on getting lease periods longer than 30 years. All of these rules are set in place to ensure there is some guarantee of recurring income, and the hard assets held in these REITs are relatively inflation or recession proof. Now that we've covered the advantages, let's look at the downside and risk. Because of all these rules governing REITs, it can be difficult for it to grow over time. For example, the minimum 90% payout ratio may mean that you have higher dividends, but this leaves very little money left over for the REIT to grow its business. As such, any REIT that requires more money to expand will have to resort to taking on more debt or to raise capital by issuing more shares. If a REIT chooses to take on more debt, this means that interest payments will increase in the future, which will impact its profits. If it chooses to raise more capital by issuing more shares, this will lead to share dilution, which means that each new share will command less ownership, and any profits paid out to shareholders will have to be divided into smaller chunks. The overall effect will mean that REITs will have a difficult time to grow its share price, and so capital gain is somewhat limited. Moreover, REITs are exposed to risks associated with real estate investment. This could be in the form of interest rate risk. For example, if interest rates on loans increases, so do interest payments and so the profits are lowered. There could also be oversupply risk, which increases the competition for new tenants and thus lowering profits. Finally, who could forget there are always economic and tenant risks. As apparent in the COVID pandemic, many REITs were forced to give rental rebates to tenants. However, even with all these concessions, many businesses were still not able to survive and were forced to terminate their leases. This puts REITs in a risky position in the near term because it becomes difficult for them to find new tenants to fill up all these vacancies. Alright, so now that we've gone through the pros and cons, let's talk about what you should be looking at before buying a REIT stock. So, obviously, you can make money from REITs in two ways. The first is from dividend payments, and so dividend yield is an important metric to look at. Second, you can also earn from capital gains, which is related to stock price. Of course, there are plenty of other metrics that are important. For example, net asset value, which represents the value of the properties in a REIT, and also management expense ratio, which relates to the operating expenses of managing these properties. However, I find that looking at all these metrics individually makes it very difficult to compare REITs across the board. So, what I like to do instead is looking at annualized historical returns of these REITs, because this will ultimately encompass all the effects of all these metrics either directly or indirectly. So in the next section, I have compiled the historical annualized returns of all 18 REIT stocks in Malaysia. Now, I won't be going into detail on how I calculated these, but I will leave it down in the description in case you want to check on my calculations. All you need to know is that these numbers have already included all the dividends paid out, capital gains, and also assumes that you subscribe to all the corporate actions in the past. So without further ado, here are the results. So as you can see, capital gains for REIT stocks are all over the place. On the bright side though, since REITs give out consistent dividend payments, if you account for the dividends, your investment will actually be net positive. You'll see that all these REIT stocks are in the green. None of them have lost any money. However, a rule that I recommend thinking about is that every time you invest your money into anything other than EPF or ASB, you should probably make sure that your investments returns at least on par or better than EPF and ASB. Because otherwise, you would have been better off leaving your money in these safe investments. So when you take these into account, out of all 18 REIT stocks available in Malaysia, 4 have consistently beaten the ASB, while 3 have consistently beaten the EPF. As always, past performance is not a guarantee of future returns. However, I like to think of investing as hiring an employee by looking at the CV. If the past performance is good, at least I know that the company is capable and has a good track record. You can always choose to research more into these individual REITs once you have narrowed them down by looking at things like their lease agreements, what kind of properties they own, the quality of their tenants, and so on. Last but not least, you do have to remember that just like any other stock, the ideal scenario will be to buy a REIT stock at a low price. An oversimplified way to do this will be to eyeball the historical chart. For example, Sunway REIT is trading near its long-term support at the moment, which could mean that it's a good opportunity to buy. On the other hand, Axis REIT is trading at its all-time highs, which may not be a perfect entry point. However, I do want to stress that good companies will nearly always trade at higher prices. And so you can see how this isn't a straightforward decision. And that's all I have for you today. Now, just to recap, REITs are a really good investment for beginners to give you a broad and diverse exposure to real estate investment without the hassle of you managing your own properties. You can start investing in REIT stocks with as little as 100 ringgit to start generating consistent passive income. All you have to do is sign up for a brokerage account, choose the REIT stock that you want, and click on buy. And there you go. You're now a partial owner of all these properties. As always, if you found this video useful, smash that like button. And if you haven't already, subscribe to my channel for more breakdowns just like these. Thank you so much for watching, and I'll see you in the next video. Bye!